What are your thoughts on that?
Yeah, and as also we spoke about hedge fund managers in our previous episodes, most of them just want quick gains and they want it short term. So if you are patient enough, as I said previously, you can just sit and wait for the perfect price appreciated by the market. I think that 2, 3, 4 years even is fairly enough if you buy the right company at the right price.
Absolutely. Let's give two more, at least from my side, on the indicators showing potential crashes, and then we can give some points from your side next, to do with how to judge when the market is going to do something big. So the next one I want to look at is when you're aware of super investors that you respect having large cash positions. This can be an indicator that something is coming, that it's going to start raining gold. And we're aware for the last many years that Warren Buffett is sitting in cash in a massive way. And Warren Buffett, as everybody knows, is considered sort of the grandfather of value investing, and also one of the world's greatest investors, if not the greatest investor of all time. The great grandfather, of course, would be Benjamin Graham. But Warren Buffett is sitting in cash, something like $250 billion in cash, waiting for it to rain gold. So if that's not an indicator, I'm not sure what is. What are your thoughts on that indicator?
Yeah, this is quite well indicated to understand. And if you follow several of these gurus, you can just go to the different websites like finviz.com, Guru Focus, and others, and you can just understand how they react. Or you can just go to 13F and also understand what they do in a particular quarter. This model of cloning is really, really powerful because when you do similar moves like the big guys, you have already kind of proof that this particular move filtered by the one of the greatest minds on earth.
I would say that to know if they're sitting in cash is a difficult thing because they don't report that on their filings. But if you know how much their fund is managing, and you can see in the filings how much they've invested, and if you know which other markets they invest in or not, you can kind of gauge how much they're sitting in cash. But for me, it's more like if I hear that Warren Buffett is sitting in cash 250 billion because he mentions it perhaps on one of his meetings, or another investor mentions how much they're sitting in cash, I find that to be much more accurate than trying to analyze it. But it is just something to consider, another indicator. Let's move on to my final indicator. And this is one that I've never seen anywhere else. It's a personal indicator that I came up with, and it's not super easy for the average person to do. So a discounted cash flow analysis is for me one of the best ways to figure out the true value of what a stock should be selling for, the true value of a company based on cash flow. And so what I did was I took the S&P 500 and I wrote a list of the 500 companies that make that up, and I put it into a spreadsheet. And then I did a discounted cash flow analysis for all 500 companies. This is a very time-consuming process, but I found it valuable in learning about those companies and also creating my indicator. And effectively, once I had a correct value for each company of the 500, and I have their prices of what they're currently selling for on the market, I got a total of both of those together, and I compared them and created a ratio. And effectively, I saw what we want with the price is we're hoping that it's going to be at the very least equal to the value of the companies. And if we want to buy at a good margin of safety, we want the price to be 50% of the value. So that way we have our margin of safety. But in this case, and I did this maybe a month or two ago, the price was double the value. And what that means in layman's terms is if you want to buy a house and you know the rent, you know how much you want to pay for the house so that you can get the rent, get the return you're looking for. So you figure out the value of the house. And then you find out the house is being sold for double the amount. That's overpriced. And if all the houses are overpriced, there's a good chance there's going to be some kind of correction. At least there is with the market, with the stock market. And so knowing that the entire stock market as a whole was double the price of the value, I would call that, to me, a very strong indicator that a correction is coming. Because as we know, in the long term, the stock prices do eventually become a weighing machine, giving the correct prices. So that's my indicator. What do you make of that, Eugene?
I haven't thought about such type of indicator, but I think it's really clever, and this is a really creative way to use DCF. This is where the advantage of all life learning really matters, because you can just imply methods and principles from one point and one sphere into the other. And when you be a creative guy, you can really do wonders. But speaking about myself, I think that one of the interesting indicator, another interesting indicator, I would say, is the average PE ratio, as you probably done, not with the 500 companies, but in overall market in the US or different countries. Looking at this number, we can understand and clearly see how much market appreciate those companies, and is the market over optimistic or pessimistic about this stuff. Because we all know, as Nick previously said, that the market goes to the average all the time. So it doesn't matter whether you are on the bottom or on the top of the market. There is always a reversion to the mean. What do you think about that, Nick?
I think it's a very interesting indicator. I'll educate our listeners just briefly about the PE ratio. So it's the price to earnings ratio, and it's expressed as a number. And a shorthand way of understanding the number is, if a company has a PE of 10, what it means effectively is basically, it's not exact, but it's trying to indicate that if you were to buy the entire company, it would, at the current price, it would take about 10 years for you to get your money back out of the profits. That's what a PE of 10 means. How it works in the private markets, if you were to go and buy a laundromat or one of those kind of companies, a frequent PE that you would buy, or a multiple that you would buy a company for, would be 7. So 7 years worth of earnings, not necessarily profits, but earnings. So that's where it's not as good an indicator as I'd like. I think it would be better if it was a free cash flow to price indicator. That makes a lot more sense to me. But we currently use earnings as the marker. So 7 years of earnings is sort of the average. If you look at all private sales, a lot of the time you can do it for 1 year or 2 years if you're lucky. But the average across the board would be 7 years for private. As soon as you go to the public market, the average becomes 14. And the reason for this huge jump is that private market, you are not certain of the numbers. You are not certain of the business. You don't have a really, really safe track record that's been audited and vetted. If the public companies fudge those numbers at all, everyone goes to jail. It's one of the places where the CEO would go to jail. It's really, really serious stuff, especially in the US. The SEC is very strict in that numbers have to be accurate, and they have to be fully transparent, and they have to tell you everything about the business in their reports. And so effectively, you know what you're getting when you're buying a public company, and so it bumps it up from 7 upwards. And then additionally, there's liquidity. If you buy a private company, you can't just sell. You have to try and find a buyer. And if in the public market, you have that huge benefit of liquidity. And so that's another reason it's gone from 7 to 14. And that's on average. A lot of companies, especially fast-growing ones, will have a much higher PE ratio. And likewise, certain industries are higher than other industries, like tech is much higher PE ratio. But it's always factoring in these different things. But additionally, it also factors in the popularity of the stock today. So if there's a massive bubble trend thing happening, meme stock, it's in the news, people are going crazy and irrational, that PE number is going to go right up through the chart. So looking at a PE ratio will often tell you how reasonable is the price, sort of. I don't think it's a great indicator, but it can be an indicator. And so that's my thoughts on PE. And I wanted to get your opinion of a different ratio that's related to the PE ratio while we're kind of close to the topic still. Another ratio that's used, and my understanding is it's best used on small companies that are growth companies, and that's the PEG ratio, and that's where they add the growth into the formula. So it's price to earnings plus growth. I've heard that indicator is fairly accurate in that you can, if it's a small company and it's a growth company, it works very well. So if the number is a 1, it means it's fair, probably pretty well priced. And if it's under 1, it might be time to buy. And if it's above 1, if it's sort of 1.5 or 1.7, it might be even a good idea to short it. Not that I would ever short any company. I think it's a terrible idea. We'll get into that later. But 1.7 means it's highly overpriced. Do you know anything about the PEG ratio?
Yeah, I do. It really helps evaluate the growth company, but you really need to be careful with such micro and mid-cap companies because PEG ratio is a tricky one. If you only invest in company based on this indicator, you can be in trouble because there are so many details in the growth companies which not only even gurus know. So you need to understand the perspective of the business. You need to understand the management so well, because if the management go out of the company, it's done, because it is actually the small and the middle business. It's not the billion-dollar company which has 100 years of history and already proven brand and already proven position on the market. It's completely different. So you need to be careful with that.
I fully agree. Never buy on one indicator. Always make sure you understand the company and that all the other things on the checklist are in place. But it is an interesting indicator. I feel it's maybe a little more accurate than the PE ratio by itself because it includes the growth. Of course, I still would prefer if it was a free cash flow indicator.
And I think that really interesting thing is the indicator which shows the easiness or availability of money. So, for example, if we are on the bottom of the cycle where the market is completely depressed and it is really hard to get the credit, to get the money for managing and investing, you can actually say that the market is depressed. But on the top of the market, you can actually get the free money. And by that, I mean the interest rates are so low that you can easily borrow the credit on your credit cards. Businesses can easily borrow money for the expansion, and hedge fund also can borrow this money. And this leads to over optimistic approaches and speculating upon different securities, which can lead to overpricing of the certain stocks and other asset classes. So this is the end of this episode. We hope that you really enjoyed it. And if you have any questions, please write them down in the comments below. Also, please subscribe to our channel for more videos, and see you next time.